Hi, everyone. Welcome to episode 23 of Zipchat. This is Jill Hurston with Excellarate. Before we get started, I just want to make sure that everybody in our audience can see our video and can see my screen. If anybody who's there, would you please just type into your chat box, your questions box, that you can see the video and that you can see my screen? I'd greatly appreciate it. I do see we have more and more audience showing up. So Martin, I know you said you can see it. Can you hear me just fine? Well, obviously, I guess if you're typing into the chat. Okay. My brain's not working all the time there. So thanks, Martin, for letting me know that. We're going to go ahead and get started. Again, my name is Jill Hurston. I am with the marketing team at Excellarate. We're here for episode 23 of Zipchat, automating end-to-end loan origination process. Before we get started, I just want everybody to know I am recording this session. You'll get a copy or a link directly to the recording tomorrow in your email. It will be from me, and then it will be available on our website. Should you have any questions during this session, please feel free to type it into your questions box, and we will get to them as appropriate. With that being said, I'm going to turn this over to our host, Mike Watson. Mike is our VP of Sales, Senior VP of Sales. And over to you, Mike.
Thanks, Jill. Appreciate it. Welcome, everyone, to the latest Zipchat episode. We're on number 23. We've been doing this since just around the start of the COVID lockdown. It was kind of a fun and exciting thing to do, and I'm still really enjoying it and enjoy these panel discussions. I learn a lot from it. Today we're going to be talking about loan origination systems and focusing on some of the key important points about these systems, like flexibility and business scalability. So today I've brought in a panel, some really knowledgeable folks. I'll start with John Maroney. He's VP of Sales and Marketing here at Excellarate. John, thanks for joining us. Also, we've got John Gelhaus. He's the CIO at Time Investment. John, thanks for joining us. Two Johns, that'll make it really confusing for me. And then finally, last but not least, Colin Lesser. He's the co-founder and president at New Spring Acceptance. Thanks for joining us, Colin. All right, so specifically around loan origination, obviously that's kind of a wide space, right? There's a lot of people loaning money to a lot of different people, but we're here to talk more about consumer financing, specifically indirect consumer financing. And within that space, I was doing some research prior to this, and there's approximately a $340 billion market in home improvement. That was the 2020 figures. I'm sure it's gone up. And in that, I think it's somewhere around 15% of that spend is done through a loan of some sort, right? So it's a pretty decent sized market, lots of players. And so with that, why don't we just jump into the topic? So my first question, Colin, since this is indirect financing, who exactly is the lender targeting their, well, like who's the target customer for the lender, right? And what are their critical pain points?
Sure. Sure. Thanks, Mike, for having me. So as Mike said, we're all indirect lenders, and on the indirect side of things, our customers are our dealers or contractors. So John G and myself, we're all participating in home improvement type loans, but there are lots of different industries that indirect lenders participate in. We're just home improvement focused at the moment. But anyways, our dealers are customers. Our customers are dealers, contractors that want to provide a way to finance products and services. And this is a very key point at the point of sale. It's a very key distinction from other lenders or financing types. So even though consumers aren't the direct customer up front, indirect lenders still have to solve for pain points alongside. Consumer pain points alongside pain points from dealers. So there really are kind of two distinct parties we're trying to solve for every single day. The pain points can seem kind of obvious. I'll go through them quickly, but the dealer pain points. Well, look, all dealers, all retailers, anyone in business wants the largest possible customer base to sell to. And the only way to access a big portion of that customer base is to offer financing. Mike, you started this by giving a stat around 10 or 15% of all these home improvement deals are getting financed. Well, if you want access to that 10 to 15 to 20% of customers, you're going to have to offer financing to win the business. This is especially true for consumers that are not able or frankly willing to write a check for the entire purchase. And also, this type of financing becomes more and more important as home improvement costs continue to rise as well. So, dealers generally need to keep working capital low as part of their business. They got to keep inventory turning. They're not specialists within finance, right? What they do is already complicated enough, right? It's not an easy business for them, and they don't also want to turn into a finance company. So, plain and simple, dealers want to be able to close more sales, and financing helps with that. Part of the market these days, it seems as though financing is now turning into a bit of a differentiator amongst some types of dealers. For example, if you go to like a website for a manufacturer of a product that has a dealer base, you can actually go through their website, look at their dealers, and a lot of times they will emphasize or at least have some kind of identifier for dealers that will offer financing. And so, if you're a consumer looking to do some sort of home improvement project and you want to finance it, your universe of dealers is within whoever that manufacturer is telling you will finance your project. So it's how some dealers differentiate themselves versus competitors. The pain point for consumers, it's also fairly easy, right? Consumers want a way to finance a sale, but I want to make a key distinction here, and this is why indirect is so important. They want to do it in the most simple and seamless way. That's the consumer's focus. Home improvement projects that are relatively small and wouldn't require like a line of credit on their home fit really well into this bucket. But even sales that are large, or at least large enough to warrant like a home equity line of credit, sometimes will still opt for the more simple and seamless solution, which is almost always at the point of sale. So look, even customers that can write a check, for example, for a project still look at financing options. And it's important to note that consumer behavior isn't always driven by the checking book balance, right? There's also some consumer confidence, which seems to be lacking these days, that also plays a role. And so I think generally, the two sets of customers are easy to identify. It's the dealers and consumers themselves, and also the pain points are fairly obvious. But I think the kind of special sauce is in how you manufacture those results and how you work with those two parties.
Yeah, thanks for that, Colin. There's a lot to unpack there, but it seems like you're saying, a lot of consumers don't want to pay out of pocket the cash to make these loans, and then another thing that I think is important is they want to close the sale in one visit, right? Like if you can't pull that off in one visit, then really hurts your chances of closing that deal. Which coming from a little bit of a sales background, I totally understand that perspective. So,
Absolutely.
John, go ahead, Colin.
Oh, I think absolutely. That's absolutely the truth, right? I think on both sides, they want to close that transaction, usually right then and there in the most seamless, easy way possible.
Yeah. So, John, just in terms of the industry and what happens in this loan processing, do you want to give us a brief overview of that, just so everyone understands what sort of how this whole process works?
Well, I'll start with the high level in terms of kind of the whole cycle of what happens. The first one Colin spent some amount of time on is who's actually going to request the loan and how is that request made. That's really the origination piece. How do I make an application? How does the lender make a determination about whether this is a good opportunity for them to lend money to this potential candidate? And then ultimately, there'll be some funding that'll take place for that particular loan, but it's likely to come from a source of funds, and that funds is kind of is the underwriting component, as you see here. So I need to find out where I'm going to take the money from. I might have more than one source. Then ultimately I close it, and then the servicing is really the payment process of paying back the loan. The real challenge I think I heard from our clients in the marketplace, and I know both John and Colin could speak to it more specifically, is really speed. Not just the simplicity of having being able to make the loan in one visit from the consumer's perspective and or the dealer, but how fast can an answer be provided back to the applicant through the dealer. And in some cases, what happens is that dealers will actually shop that application to more than one lender. So the premium is on the lenders that can make good decisions quickly with the available information they have. So one of the challenges is pulling information from different worlds, if you will, verification of income, background checking, credit history, and being able to kind of build that into and mix that with some of the promotions and pricing that the lender may be offering that might be very specific for a time period, for a dealer, whatever, so that how they differentiate themselves. Being able to make changes to that, as well as be able to quickly get to a satisfactory answer of whether we're going to do it or not, that's all in this origination screening area, where speed as well as accuracy is a really important aspect.
Yeah, it totally makes sense. I recently, say 4 years ago, I purchased some solar panels, and I experienced sort of the pain points that Colin mentioned in this process, where the sales guy was there. We wanted to purchase it. We didn't want to pay cash for it for whatever reason. So, we went down this loan process. We had a hiccup with our credit that had them go down to what I've since learned is a waterfall process, where we go to different lenders. And then ultimately I didn't want to pay like the premium on the subprime. So then we went through, another process. This whole thing took several hours. And it was very frustrating for me and my wife. And it was frustrating for the salesperson who just wanted to get home to his baby. He had a baby like a month before, right? So he's like stuck there. He's on the phone. He's trying to wheel and deal because he really wanted to close the deal, and we really wanted him to close the deal, right? So that was like real world, where those pain points come in, Colin. And I got to, like I said, I got to experience the whole thing from that side, which was very interesting. We have solar panels. We're very happy with it. All is well in the world. So let's move on a little bit from that topic of what is the loan origination process, and move a little bit into what are the requirements for a good system, right? So John, you sort of mentioned that, like speed, and we talked about flexibility as well. So my next question again is for you, Colin. What do you think are table stakes for this type of thing, and what do you think are other important features?
Sure. I think the core of any LOS, at least from like a credit perspective, which is what we've been talking about, is the ability to kind of quickly pull data and then aggregate data, kind of in an organized, accurate, and automated way. I think John actually spoke a little bit about this just now. I'm sure decades ago, this data was all pulled and spread manually, right? And I can't imagine the amount of time and FTE that process chews up. It's just not how the world operates anymore. And that's not something I don't think that's unique to finance companies. I think this is just modernization that has happened by systems and technology across really any industry. Our modernization tends to be just more focused around automating and kind of aggregating data. And so, at the core, I would say, of any lending decision, regardless of the lender, it's data is going to be the core of it. Data informs the decision about whether or not you should lend, and if you do lend, at what terms. It's a complicated process, and generally, with the more data points you have, you're able to make better lending decisions. So there's always kind of that constant need for fast, automated access to data in our world. That generally requires inputs from a lot of different sources, right? We're talking about credit bureaus, independent score companies, ID validation, homeownership validation. There's a whole litany of sources that lenders use on a more automated basis to pull and aggregate data. And I will say that there is absolutely zero value add to pulling any of this manually. In fact, the automation of this data and the process is, I believe, as to your phrase there, Mike, that is the table stakes for a lending business. Not automating the process of the data not only costs you time and money, but frankly, it hurts your ability to offer a competitive product to your dealer base. And so, yeah, I mean, I think that frankly, the table stakes are in the pulling, aggregation, and spreading of the data itself.
That makes sense. John Gelhaus, John G. In our prep calls, we've talked a lot. You mentioned this word frictionless quite often. Like, how do we make this frictionless for our customers? And so, why don't you describe what you mean by that, and what do you think a frictionless system looks like?
Well, as a consumer finance company, you have to work how the dealer wants to work with you, which effectively means supporting how they want to go out in the marketplace and sell, and also interface with you to bring a credit app in, to have that be decisioned, have a promotion selection. The dealer is not under an obligation to offer financing when that offer comes back from the finance company, right? They're going to evaluate whether or not they want to pay the cost for that financing to be able to sell the product to the consumer. So you have some dealers and contractors out there that are very old school, and they'd be happy taking a carbon form out in the field and calling in a credit app, right? You got to be able to take that credit app into your origination platform to underwrite it and to evaluate whether or not you can give an approval, a decline for derogatory credit, or if you're going to pen that application and you're going to take a deeper look at it. Some of those dealers want to use your portal to submit the credit app, and they go through that process to get to a contract that they can then e-sign. Others, the really large dealers and brokers representing many organizations, might want to use their own systems. They might have their own platforms. And so you've got to integrate, you as the finance company have to integrate your systems to those platforms to be end-to-end API integrated for a seamless experience. So when I talk about frictionless, I'm really thinking about the degree to which you support the business transaction without having to switch channels, right? The worst thing you can do is if you get part of the way down the business transaction and the system can't support an exception or can't support something that they want to do, and it results in them having to call. If you consider millennial and even younger generations, they spent their whole life on mobile phones and tablets, and they have an expectation that the technology is going to work, be very efficient, be going to be very fast, and they're not going to have to switch channels. Because if they have to switch channels and they have to go on to your chat or they have to call you to resolve an issue, you might have lost that deal as a finance company. They'll send that to one of your competitors. Some examples of this. Let's say that you're in the middle of a deal, underwriting a deal, and dealer says, you know what, my consumer doesn't want a revolving line of credit. They want to do this as a retail installment contract. Can we switch this? Does your system allow for that? Or does it require somebody to manual effort to change that? Or an example in the servicing cycle after the loan is originated, consumer is on your payment portal and they want to make a payment. Maybe they want to switch from a scheduled ACH payment to using a credit card, or to use Venmo or PayPal or Apple Pay or Google Pay? Do you allow them to do that? Do you allow them to basically self-service and run the transaction at scale without your involvement? If your process, and by extension of that process, your systems don't fully support that end-to-end within that channel, you're introducing friction. And friction is the enemy of efficiency, and you're going to lose that deal to your competitors.
Gotcha. So you want to make it as easy as possible for the dealer to choose your product and work with your product. I mean, that's at the end of the day, that's what you're saying, it sounds like.
Yeah, there will be other finance companies in your credit tier, in your market segment that you're competing against, and your technology, and the seamless way that both consumers and dealers interact with you is your differentiator. So if you can't stand out and have a very efficient and scalable process, you will lose that business to your competitors.
That makes sense. So actually, you just triggered a bad memory in my brain about that same loan that I got for the solar panels. On the servicing side, payment portal, I had a real challenge there. I wanted to change the amount, or maybe it was the payment type, and it took 30 days to take effect. So then I would miss the payment in between because like the actual change didn't take effect, and then the payment date came, and then there ended up being like a late payment, which didn't make any sense because I had payment information in there and I'd done all the things. So
that's an example of friction where you had to call the lender and resolve the problem manually.
Yeah, that's exactly right. And then they had to inform me of their policy, which wasn't stated anywhere, that it takes 30 days for these changes, but it eliminates your original, thing. So it didn't take effect of what I was doing. It took out the payment option, but then put in a new one 30 days later, which left me a gap, so don't do that. I don't suggest doing that. That was very frustrating for me. All right, so one of the things I learned through this process is that there's like tiers of lenders, right? So technically John, G, and you, Colin, you're not competitors, right? So you play at sort of different levels. So, I mean, maybe you can briefly describe those levels. Maybe everyone understands that, but more interestingly does the scalability and responsiveness have to change at the different levels? Like, is it, are there things that are more important at the higher tiers than the lower tiers? I guess that's what I'm asking, where I'm really going with this.
Yeah. So the short answer is yes, there are differences in terms of efficiency and scalability and speed and all those things depending on where you play in the marketplace. But I do think there is some commonality with all lenders when it comes to, I guess, balancing a couple of things. Maybe the first being balancing quick underwriting times. We've talked a lot about, being fast, but there's a balance between being fast and the second piece, which is just balancing the complexity of underwriting risk. Maybe for example, making a credit decision on like a super prime customer can be mostly, if not entirely, automated. That's a generalization, but as for argument's sake, let's just say it can be entirely automated because it's a fairly simple process with very little risk. You're not dealing with a risky consumer. If you're looking to compete for those types of customers, you're going to have to strive to kind of always be the fastest response because you structured yourself to compete in the largest volume marketplace, right? And so as you move down the credit spectrum, like in a scenario where maybe like the super prime and the prime lenders have declined to extend credit, which those decisions happen very quickly, but they've come back as a no. The motivator, I think, becomes less centered around speed and frankly more focused on just getting an approval. And that would allow, frankly, the dealer to complete a sale. So even if it takes a few more minutes to underwrite, that's still an acceptable outcome. And so, so I do think there's a bit of a difference while we were talking about lenders and the markets that we play in. And also, I point out that because of the world I live in, but like the process of underwriting, you know, and pricing more risky customers can be pretty complex. And traditionally, still has some manual components that, for example, prime and super prime just don't have. And so it just generally takes more time. And by the way, it's more expensive to do on a per application basis. So, you know, in general, responsiveness and kind of expectations around responsiveness vary across the credit spectrum. I'd like to add that, you know, as an indirect lender providing a financing solution at the point of sale, you still have to offer a product that simplifies the transaction. Back to what John G was talking about in terms of providing a frictionless answer, you still have to provide that regardless of the credit focus. Because if you don't, you're going to start competing with other types of products like direct lenders and home equity lines of credit. And so at some point, there is a baseline of kind of service and efficiency you have to provide, but it just kind of ratchets up the further up you go the credit spectrum.
So maybe one way to position this is that the speed still needs to be, you still need, you know, a good response time, but it's relative to the problem that you're solving, right? If you're, you know, if it takes longer to figure out whether you should provide a loan to someone, do that underwriting, then of course you need that extra time, but you should still be faster than your competitors, I would imagine.
Absolutely.
Yeah, makes sense. All right. So, John G, you know, you're sort of playing in the, I guess we're calling it the prime tier. Anything you want to add to that, or you know, anything interesting from your perspective in terms of key differences in the tiers?
Well, I agree with everything that Colin said. So we're in agreement there. John Maroney mentioned this up front. He mentioned the word waterfall. And so as you go down the credit tiers from super prime to subprime, the lenders are going to be waterfalling business to each other. You know, a big volume player that's operating nationwide and it's focused on super prime credit, maybe they stop accepting at a 700 credit score, right? Below that, they waterfall that down to my size business at prime, and Time Investment does waterfall down to other organizations like Colin that operate in the subprime space. So the nice thing about that is, as an applicant, in your example, you might be applying for credit for solar panels, right? What would have happened if you didn't have to go and apply with another company and go through a whole underwriting cycle again? But all the information that was captured up front in the original application with the super prime lender was made available down the waterfall to other lenders. They then can use that information and make a decision. Now, in the case of prime, we try to make decisions somewhere between instantaneous and say 30 minutes. So we're auto approving good credit, we're auto declining derogatory credit, and our sweet spot is really what's in the middle, right? That we might be looking at an applicant or a co-applicant with maybe their credit's on the edge, right? But you still want to find a way to be able to say yes. Maybe they need to add a co-applicant, or maybe they need a bigger down payment, or maybe there's other income that can be disclosed. And we're trying to get to a yes decision for that dealer so that they can close more sales.
All right, that makes sense. Yeah, it's interesting. You were just talking about the wouldn't it be nice if you didn't have to go through that thing? I think in my example, if I remember right, this was 4 years ago. I think he used an iPad for one application and then a phone for another application, then back to the iPad for the third application before we finally got something.
Over and over again.
Yeah, and I had to keep giving him all my information because, you know, obviously he didn't write it down separately. I think after the second time he did write it down, but like, I mean, it was very difficult for him, right? Because he was, context shifting, multiple different channels, I think you called it earlier. So yeah, again, it's just interesting how I saw all of this pain. So is that a challenge that that either of you are solving, like how you share information along the waterfall, or is that sort of more of a dream right now?
From a technical perspective, it's happening. Our systems are API enabled, and we are connecting to enable different lenders across the credit tiers. And I suspect all of our competitors are doing the same because it gives a better consumer experience. And if at the end of the day, your goal as a finance company is to allow your dealer to close more deals, sell more product, that's a great way to do it.
Awesome. So John Maroney, I know we have a few customers in our portfolio that work on these types of products. Do you have any insight into how we're solving those problems, or what problems we are solving for various customers of ours?
Well, I think John and Colin could express this a little better because they've lived through this. But what we see sort of in the landscape of lending organizations, they may have their own systems that they've built themselves. In other cases, they may have an integrated loan origination system that might have a front end that can interact with applicants and dealers. But it seems as if that front end area, the interaction with the dealer network and with the consumer, and the ability to provide the openness, for example, that John talked about, being able to offer the loan updates and information on a mobile device, that really means you have to have a fairly modern system. If you built an older client server application, it probably wasn't built for the web, and it's not going to be easy to work with mobile devices. So what we often, and because of the nature of that front end operation, at least a big part of it being speed and the ability for the lender to be able to change terms and pricing and promotions and things of that sort, standard commercial off-the-shelf systems have limitations to what you can do. So it is probably one of the best places to look at doing, let's call it custom, but the options of custom don't necessarily mean that you have to build it from scratch. You might be able to use a platform, a pretty common platform that the sales team might use at a lender is Salesforce, and the Salesforce actually does offer the ability, because it's a low-code platform, to be able to do some of this. It's pricey and maybe some other kind of constraints, but I would say what we're seeing is organizations recognizing that they need probably their own tools, their own applications to be able to interact with their consumer and targets, and whether they build it themselves, whether they try to modify an off-the-shelf application, or perhaps look at using a low-code application that can be easily modified without having to get into the source code and deal with all the ramifications of a custom software platform. That's kind of what we're seeing at Excellarate.
Got it. So a lot of integration and then maybe some UI, UX type of help.
You bring up 2 points there. So yes, is the UX going to be very easy to use? Is it going to be modern? Is it going to support all the various technologies that people might use to interact with? And the second is it has to be tightly integrated, high degree of security, high degree of scalability, reliability, and speed. So to some extent, you're going to be pulling and interacting with, at a very high rate, a lot of information.
Yeah, that makes sense. So that goes with the frictionless concept, and also we talked about the speed of the application. Like I think those being able to build a system that has that, and but also leverages, like you said, the off-the-shelf systems that provide a lot of the heavy lifting, right? Because if to build it from scratch, I think would be just a massive endeavor. So on that topic, I want to drill in a little bit. So Colin, you're working at the lower tier subprime, right? and when we talked about this before, that generally means smaller companies, which would mean smaller budgets. So when you think about COTS systems and your architecture and like this integration that John's talking about, like how do you approach that? Like what's the approach with COTS and integration?
I think it's a balance. It's a balance between what the available resources are, or at least the needs of the business, versus, or at least balancing that with the available financial resources, right? I think in a hypothetical world where you have unlimited time and unlimited budget, you'd prefer to probably build everything, right? And not utilize anything off the shelf. But unfortunately, that's just not the reality for anybody. So I think the decisions start with a good understanding of the market you're trying to compete in. So you know the systems that are required. As you already mentioned, Mike, like my systems that I'm going to use are going to be very different from the systems maybe that John uses because, my speeds are different or they vary or my process is different. And so I think just understanding which of those components play a key role in your offering informs what you should be buying versus building. So effectively, identifying what differentiates your building or differentiates your product or your business. And that's, I think, the way to start thinking about maybe kind of building versus buying. The caveat here is, I think, and maybe this is somewhat obvious, but it means that activities that are more perfunctory, like in nature, are going to lend themselves really well to just off-the-shelf solutions, right? Where, the more critical or the more advanced, especially if it means your product, those are the candidates for, the building piece. Like, for example, this isn't like an LOS example, but we were talking about servicing stuff earlier, and it got my mind racing because those are other complicated systems. And one of those things, like, for example, is like if you want to build your own servicing system, right? You're going to do it so that you can split your payments between principal and interest. That perfunctory process adds absolutely zero value. It's a solution that's readily available off the shelf. And that's exactly what the off-the-shelf systems are designed to help with. And they do it in the most accurate, reliable, and cost-effective manner. If you differentiate your product in the marketplace by speed, which we've talked a lot about, right? Utilizing the same off-the-shelf systems that your competitors use, it's not going to allow you to effectively compete, right? You're delivering at the same speed that they are. So in that scenario, you're probably looking to do more building versus buying. And we've talked, I think, a lot about this already, but like in subprime, a lot of my differentiation comes from the underwriting and credit process itself. And so speed isn't necessarily as important. It's not the key differentiator. So it's not a coincidence that you'll find more subprime, underwriters using more off-the-shelf technology from an LOS perspective than the much larger kind of volume-oriented prime and super prime lenders. Subprime is a kind of a lower volume, higher margin business, which tends to require different solutions than prime lenders that tend to be much higher volume and kind of lower product margin.
Yeah, understood. So that's making me think, so if you're a super prime, you probably have an army of developers and you're, making all these custom features and you're probably, small, tiny rate adjustments and small, tiny speed adjustments are making a difference for you, right? But if you're in the sort of the prime market, like John G, your company, Time Investment, you probably have to invest, differently to get those same sort of I wouldn't call them minor gains, but gains, right? So how does that affect your architecture decision making?
We want to be smart about where we apply customization. And you're right, as you move up the credit tiers from subprime to prime to super prime, the amount of investment that you're able to make greenfield systems is proportional. So in the mid-market space, the BC credit space, we don't necessarily want to go all in with commercial off-the-shelf systems and change our business process to fit the product. And we don't want to go the other end of the spectrum and go all in on greenfield. We want to pick to do the kind of development and customization that allows us to differentiate. It's the secret sauce, so to speak. So that would mean choosing commercial off-the-shelf systems that are highly configurable so that you can be in control of the user interface and the data elements and how those data elements are reflected on screen to your employees, the underwriters, and out to your external facing dealer portal and APIs. You don't want to have to go to the vendor and do customization with their IT department because you're competing with the vendor's other customers for similar needs for customization. But as you increase the amount of customization, you also decrease the ability to maintain that system, and you increase the long-term cost of operation of that platform. So as you're choosing to invest in some customization or additional configurability, you want to do it for the right reasons. And mostly that is where you need the product to adhere to your business process. You're not willing to change your process to fit the product because you're going to lose efficiency. Or where, for example, you're choosing a platform that isn't open. These commercial off-the-shelf systems you choose to use, in order for you to hook the rest of your business process into them, they better be open architectures and have APIs, be API driven. And then, of course, you have to pay attention to how they're hosted and secured, right? You don't necessarily want to choose a platform that you're in the same multi-tenant instance as all the rest of the vendor's customers, because there are times when one of the vendor's customers does something and it negatively impacts your ability to operate or stay available. So it's a difficult balancing act between off-the-shelf customization, cost, and time to market.
Yeah, interesting. So if you're working with these COTS systems, this is a question for both John G. and Colin. If you're working with these COTS systems and they're hosting some amount of your data, most likely, like how do you rationalize that data? How do you retain ownership and avoid stickiness, I guess? Or is that something you worry about?
Colin, you first.
I'm gonna let John G. He's the technical guy, cover most of that, but I can jump in after. How's that?
The reality is
nobody wants this one.
The reality is
that's right.
If you put your data into a public cloud hosted platform as a service, a commercial off-the-shelf offering, and it doesn't have the kind of open architecture that you need, you have lost control of your data. And if you don't have a core ERP that where you can replicate that data into or integrate it into such that you do have control, you can become at the mercy of that vendor because they own it. And there's some classic examples out there of cloud-hosted low and no-code platforms that once you're in, and it's really hard to get out of them. It becomes increasingly difficult to control your destiny once you're in those environments. So open architectures that can be driven by single tenancy, where you're not fighting other customers of the vendor platform for resources, can help ensure that it fits into your overall architecture long term.
That all makes sense, because data, I mean, the reason why I bring the data thing up is it's just so important now in all industries, right? Another thing that I had a question about is like flexibility. Like there's this trend that I'm seeing across a lot of industries, thinking about data and other things. And this flexibility to configure your product without having to get a lot of IT support. I mean, that's just a growing trend. I mean, part of that is like, how do you use AI to do that? And, or, how do you build interfaces to make that work? Is that something that's important also here? I would assume so, but I'd like to hear your opinion on that.
It's table stakes. It's absolutely required. If your system is not configurable and requires high degree of customization, you shouldn't choose it. And there are some origination platforms in the marketplace that are a little bit old school, do require a higher degree of customization as part of that lender's implementation. long term, those will be more brittle kind of exchanges. They won't scale, and they won't be as efficient as you need them as the market changes and you have to adapt to it.
I'd like to play off that a little bit in that, and I'm sure both of, particularly John, but probably you, Colin, can speak to this. The loan origination system isn't the only thing. There's a lot of information that the lenders need to have access to that's available through third parties. And there are tools that arguably are table stakes. I mean, electronic signatures, right, John? I mean, if you don't have an electronic signature feature, you're fighting with one hand behind your back. There's more than one vendor that offers that. Which one do you pick? Maybe one will be better for in the future than another. But if you built that in or you tightly integrated into your system, it makes it hard to switch from that, right? So you've got employment verification information. Everybody knows about Experian and TransUnion. Those are things that I know lenders have to go out and they need to ping those and get information back. You might want to choose from more than one. You might want it to be easy enough to drop one and get another.
You're absolutely right. That's difficult. It imposes a huge burden on your development staffs. And you will have to change vendors based on changes in ownership in the market, changes in new features coming out, and then probably price is one of the biggest ones. You choose an e-sign vendor and suddenly they increase your rate by 200%, right? You need to be able to switch to another one in a reasonable amount of time so your workflow is not disjointed, doesn't have a manual step in it.
That never happens, does it?
Never.
The other thing I point out here is talk about table stakes here and systems specifically. Having a system, whether it's off the shelf or whether it's homegrown, that has the ability to integrate with these ever-evolving vendors that are offering these products to help us with the underwriting piece is pretty crucial, right? So I can't imagine a world where the market slows down. It's always evolving, and there are always other solutions. And if your system isn't able to integrate with those other third parties that are offering you more information or more data, you're either locking yourself out of that data and making bad decisions, or at least not as informed decisions as your competitors. So therefore, you're going to be adversely selected and likely out of business. Or you're doing it manually, right? And you're just, unable to compete on speed anymore, right? So having that kind of functionality kind of inherent in the architecture and the system is very important, because as John and I can attest to, I think it's a very different market today than it was 10 years ago in terms of the solutions that are offered, the data that we look at. And I bet in 10 more years, it'll look very different again. So yeah, that was my 2 cents there.
And that's if you're optimized for a specific market or business segment today, and tomorrow or next month, your CEO decides we need to get into this line of business, and we have a loan origination system. I have an IT team. Why can't you just turn it on and support that business, right? And you guys know it's not that simple. There could be a whole bunch of new unique business workflows that are associated with that. And third-party apps have to get integrated.
Yeah, I've gone through the process of trying to incorporate a new product further down the line after a launch that in my mind should have been relatively simple because it used the same concepts as prior products, but the complications in the build and the architecture were much more complicated than I could have ever anticipated, and it just took a lot more time, frankly. So
yeah, that's not uncommon. Like the devil's sometimes in the details, as the adage goes. I have a long software engineering background, mostly software leadership, and some small decision somewhere made it almost impossible to add this second product, right? I mean, that's so common. Like, it's unfortunate, but it's just the way that these things work.
Yeah.
So I imagine, we talked about some competitive positioning and, the market changing and being flexible to that. I imagine, rates, promotions, things like that, those are all things that you have to have to deal with, your competitor comes up with a clever way of, providing options. I imagine things like deferred financing and all these kinds of things come into play, right? So I imagine those are some of the flexibilities. But there's a bunch of things that are just common to any kind of system, from my experience, right? So keeping costs low and reducing the need for, full-time employee growth, right? So I worked at a lot of growth companies, and it's not about reducing staff, it's about using the same staff to do more, right? That's always a thing, right? How do we do this, what we're doing now, better so that we can do more business and not have to grow our expense side? And then, ultimately that creates business scalability, right? Like the more it's the flywheel effect that you talk about, right? You can do more with the same amount, or with small incremental amount of extra gives you more, twice as much or something like that, as opposed to just, a small increment of revenue. So I imagine those are all factors that come into play. I guess with the remaining time, so we have about 10 minutes, I wanted to go into another thing that's, I don't know if it's unique to your market, but it's definitely, something that anytime money is involved, there's a lot of regulations. So, John G., tell me a little bit about how regulation affects architecture and decisions you're making in terms of product.
But talking about regulation, there's a couple of themes, and I realize we've got about 10 minutes left. There's been some themes that are more prevalent in the last few years, and they mostly center around consumer privacy and information security. And then the other one that comes to mind is the sensitivity of consumers to receiving telephone calls and text messages as they interact with their business relationships. Some examples of this: you get the California Consumer Privacy Act, similar to the GDPR. I expect other states to follow similar paths and introduce regulation that business operating in those states will have to meet. Another big one that you have to make sure your systems take into account is just comprehensive information security. And a good example of regulation around that is New York DFS 500. It was really a first in the nation comprehensive information security law. And it's really just basic things like, do you have encryption at rest? You encrypt in transport? Do you offer single sign-on? Do you support multi-factor authentication? Do you have a DR plan to provide for availability for that? And then more recently, another one that comes to mind is municipalities that are seeking local or regional rules that are more stringent than their state. So an example of that would be calling rules in New York City, as an example, may be more stringent for people living in the 5 boroughs than in New York State. Well, how does your system identify somebody that lives within the 5 boroughs? You can't do it by postal code. You have to actually know the geographic position of that consumer, and does certain calling rules apply? At the end of the day, right, to be able to implement these rules and to be able to respond to the regulatory environment, configurability is key in the systems. You want to be able to implement those rule changes that are coming from regulatory bodies quickly, and rule configuration allow you to do that. If you have to step back and you have to go to the IT department and get changes implemented to code, you're not going to be able to meet that ever-changing regulatory environment. And it seems to be, Colin, increasing in the speed of change as states go after regulations around privacy and security.
Yeah, I would very much agree with that. It feels much more like regulation of old was centered around servicing and collection practices, and there was very little focus around, not as much focus, I should say, around privacy, although, I mean, there's always GLBA and there's always customer privacy rules, but those rules in terms of customer privacy and information have really ramped up as of more recently, right? So it's gone from rules regulating a process and how you do business, into the kind of more, I don't want to call it invasive, but it's the more the deeper view of protecting consumers and their data and putting safeguards up to make sure that the privacy is protected. That wasn't, I don't think, as concerning to regulators 10 years ago. It's clearly the focus of kind of where things are today.
One of the keys I can think of in kind of meeting those regulations are auditability around your business transactions. It's not enough anymore just to have the data of the business transaction. You also need to know what employees viewed that data, changed it, what did they change, and when did they change it? Because you may have to attest, you may have to respond to a regulatory agency on behalf of a single loan or a group of loans. Tell me exactly how these were underwritten, who saw them, how were they done?
Yep.
That means fundamentally the systems have to capture a whole lot of data, or time, date, time, what, when, where, kind of things.
Who made the decision? Those kind
that older platforms just didn't do.
Yeah, and it also goes back to in today's day and age, as you do answer those questions, answering with that data what is systemic, right, versus some one-off anomaly or error. And I think that's also something that interests regulators in terms of whether something is systemic or a one-off. I think that's always one of the upfront kind of questions regulators have to ask themselves as they go through these inquiries. And so, to John's point, being able to show that with systemic backup that there's no issue is very important.
Gotcha. So we're kind of at the end of our planned content here. We probably went a little bit longer than we expected. We only have about 4 minutes. We did have one question from the audience, and I do encourage the audience to reach out if you have any other questions. If we're not able to answer those questions live because of time constraints, we can always get back to you with answers on those. You can reach out to us directly. Our contact information is now on the screen. Happy to hear from you. Happy to answer these questions. So the one question that I had from the audience that I think is interesting is, let's just say, I'm paraphrasing the question, but basically it's, let's just say I inherited this, system. I come in as CIO or some kind of product manager type role, and it's not scaling, it's not flexible enough. Like, where would you start? What's the process for moving it? Let's just say digital transformation. How do you make that transformation?
I can take a swing at that. It's number one, the hardest thing you'll ever do, switching from a legacy platform to a new platform. I'm now involved on my second major replatforming to solve that problem. And one is to really go out in the marketplace and evaluate the options and try to evaluate and measure how closely they align with your business segment. So do they align well? Maybe you're in subprime, right? And you don't require a lot of customization. You're able to do more out of the box. Well, do they still have configurability? Do they still have high degree of hosting? I would say another key question you have to answer is, are you going to move your book of business from your legacy platform to the new one? Or are you just going to try to run off in place? My advice would be, after you made some product selections, try to avoid the most complex areas of these projects, which tends to be the customization to try to fit the product to your business process, and also the data migration from your legacy platform to the new one. Any ways that you can simplify that by choosing a product that meets your business processes to the highest degree possible out of the box, and then allows you to configure on top of that, is probably the right approach. Would let you get to market faster and with less cost.
So if you were to choose something that has sort of a low code or no code kind of profile, in terms of these vendor selections, that might be something that can help you, because you can configure on the fly and you're not as dependent on getting it right.
Yeah, low or no code are great options. configurability that's also baked into the platforms is, is very important. So probably the third factor is the degree to which the architecture is open and is supported by APIs. If the table stakes are being able to get data in and out of the system from all the data sources that you need for credit underwriting, and then also to feed into the other systems that support your business process, it better have an open architecture fully supported by APIs. That is what's going to enable you to connect it and not have a lot of manual handoffs and a broken process where you need to have it scale.
That makes sense. All right, so we've reached the end of time. I want to thank my panelists, John, and Colin, for joining me today. It's been a great discussion. I've even managed to learn even more about this process. And also, I want to thank the audience for taking the time to join us as well. We do this for you. Hopefully it was educational and it'll help you in your journey. Thanks again, everyone. Have a great day.
Thank you.
Thank you.
Bye.